To remain updated with the latest business news, click on the bell icon.
Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee. With me is Abha Bakaya and our guest on the show today, Basant Maheshwari, successful fund manager, founder of the Equity Desk and also well-known author. Basant, good to have you on the show. It's quite a day to have you on because markets seem to have got into full-fledged correction mode. What's the sense you're getting? Is the correction about to deepen significantly from here?
Good to be with you then after a while. But on a very broad scale, this is not our bull market. Our bull figuratively is borrowed from NYSE. So when the Dow does well, we do well. When they do badly, we do badly. This is not our bull market. And because there are concerns in Europe and US, we are falling with them. But if you ask me on a broader scale, I think the best is behind and the worst isn't too far away. So maybe we just hang around here, maybe 5, 7, 10% on the Nifty. But the best to me looks behind us. And I say this with some reason because with every passing week, every passing quarter, every passing month, you would be nearing a phase of interest rate hikes. Whether they would do it or they would not do it is another issue. But the markets are always skeptical and they panic first. Reasons come later.
So if an investor has a horizon of maybe a couple of years from now, say looking beyond 2022, what should one expect? Subpar returns, average returns, or capital erosion?
I think 2022 calendar year, if you can protect what you have made, maybe make 10% on that, I think it will be a great feat for you. But broadly, if you think that you would leave the markets and then come back in, markets never send us an invitation to join back. So if you leave the market, you're left out. So you have to be here. You have to take the pain. It's like what they say, Jeena yahan, marna yahan. You leave the market, you're left out. So you have to be here, even though you know that the returns would be not so great.
And would you distinguish between large caps and mid caps? Because when a correction is looming, a lot of people switch to the safety of quite expensive large caps. Do you see 2022 being a year like that, where mid caps underperform large caps, or you don't think that necessarily follows?
For the moment, everything is falling because the foreigners have sold 80,000 crore worth of stock. So, but broadly, the foreigners cannot keep selling till eternity. They would stop at a point. And then the buying shifts back to large caps. The initial phase of a bull run is led by large caps. The mid caps join the party later on. But I think it's the time to be with larger players than try and look for the gems in the dust kind of a theme, because it is very, very difficult for people to do well when the broad market itself is not in a roaring bull phase. So it's better to be with large caps right now, with dominant industry players dominating the industry, rather than go and look for the small cap and mid cap themes right now.
Basant, you've been fairly positive about the economic cycle and how we're poised, at least with regards to domestic factors, at the cusp of a new growth phase. Does that scenario remain intact? Do you feel that global headwinds apart, the domestic story can still play out?
No, I have a different view, Abha.
Okay.
I think domestically, there are headwinds.
Okay.
Globally, we are still floating because there's so much of liquidity and we're doing well. So what is doing well? I keep saying this all the time. The global auto companies are doing well. The global metals are doing well. The IT is in another phase. The pharmas did well in the initial phase. What isn't doing well? Banking, financials. And they are the core of India. So these banks, 99% of their operations, maybe 100% of them come from India, and they are not doing well. So basically, there's some problem with the domestic economy. Internationally, because there's so much money chasing stocks, those companies are doing well.
That's an interesting point, Basant, because there is so much heartburn about the fact that the bank Nifty is not doing well, and the common perception seems to be banks are not doing well because FIIs own them and FIIs is selling, and therefore HDFC Bank and HDFC and ICICI cannot do well. But you're saying that it's not just a technical factor, that there is a fundamental reason for it, for why banks are underperforming the market.
Udayan, FI is also on the IT stocks. They own Infosys, they own TCS, they own the HCL Techs, the Mindtrees, the Coforge and everything. But those stocks year to date, they have delivered. So it's good to see, we did this study. So when the FIs start to sell, everything falls. But after 1 month, after 2 months, it's like things finding their own level. So the water finds its own level. The good stocks come back. So banks, I think they're in some sort of a bother. They've gone up because there was so much of money floating around. Kotak Bank, I think year to date hasn't given positive return. It could be 1 or 2% here and there. And Kotak is one of the pristine banks in India. So there is something wrong which is happening. So maybe I don't know what's there. Maybe the COVID, the lockdowns, the overarching fear of nothing big happening right now on the domestic front. But whatever it is, I think the bank nifty and the financials are in a problem.
You also mentioned the global commodity cycle. There, people made a lot of money through 2021, but the last few weeks has been quite brutal for even metal stocks. I mean, names like Tata Steel have corrected by 300-400 rupees. Do you think the commodity cycle is over, or would you use this as an opportunity to own stocks like Tata Steel?
So if internet and digital is defined by what happens in America, I think metals like steel and aluminum is determined or defined by what happens in China. So there are two schools of thought. The first school of thought is to assume that China is going to grow at sub 5% next year. Then there's a huge problem everywhere. The second school of thought is China wouldn't grow at sub 5. They would grow at 6, 7, 8%. They would need to reflate their economy. And there China is playing a great trick. They are cutting down interest rates. America and Europe are increasing interest rates. So I think the balance of trade is shifting towards China. I think China is the only player on the chessboard who can go and tell Powell that, wait, hang on a minute, you cannot raise rates. So I think China growth would come back. And importantly, as long as China doesn't export metals, we are all fine. All the previous last 2 decades, if you go around, all the metal hammering has come across because China was exporting deflation across the globe. So if China is not exporting, and they're not exporting because of climate reasons, and they've removed their export incentives to metals for like steel and aluminum also. So I think we're all fine. But for the moment, when things fall, everything falls.
All right. Which are the other parts of the market, Basant, that you would say avoid? Because that's also what an investor should know right now, given that, we have seen markets correct at the start of the week. Would you suggest, in your past interviews, I know you've sometimes talked about even the new age stocks, for instance, tech, anything else on that list, perhaps, that would be a clear avoid right now?
I would avoid a company that's trading FY24 500 times PE. So we've known to be buying high PE stocks, but high also has got a level. You can't buy a stock whose PE is at 500 FY24. So for a company like Zomato, great business. So what's the problem in Zomato? There's no problem as long as you get fresh funding. If there is a bear market, you can't do a QIP. If you can't do a QIP, who gives you money to burn? Nobody. So that's a problem. These are not recommendations actually, but it's just a representative of what we think actually. So these are stocks where you need fresh funding. So even if you don't need fresh funding and your stock is trading 500x FY24, as bad as anything. So you wouldn't want to be caught in that kind of a whirlpool for that matter. So these are stocks which look good. You got a listing in, you made money, go home, enjoy.
You use that dangerous phrase, Basant, bear market. Are we anywhere close to it in your book, or it just slipped out?
I don't know. But at least for me, I think it'll be very difficult for us to reclaim the old highs. So we're already in a bear market with them. Stocks are down 30%, 20%. Portfolios from the top have given away 25, 30%. So, I mean, to be categorized as a bear market, you don't have to lose half your wealth. You're losing 20% also is bad enough for you to be calling it a bear market. So, in India, we've got this fascination. We never call it a bear market. We always call it a long-term structural bull market and a bear phase in that bear market. But if your portfolio is down 40, 50, 60%, I mean, better call it a bear market than try and deceive yourself by saying we are in a long-term structural bull market with a bearish phase in between.
And what happened to that story that we are entering or have entered a new earnings cycle, and therefore earnings growth will keep coming through over the next couple of years, and that will pay for valuations which seem a little elevated at this point in time? You are not a believer in that story?
No, we are getting earnings growth. We are getting earnings growth in IT. We are getting earnings growth in pharmaceutical companies. We're not getting earnings growth in our banks and financials. So these are Indian companies with US operations, most of them. So though and Nifty, by the way, is one of the best funds to invest in, because by default, Nifty is made up of 60% secular growth businesses. You don't have to go and pick stocks right now. The Sensex of 1992 and the Nifty of 2022 are, in your words, chalk and cheese. They're so different. You don't have to employ a fund manager. Go and buy the Nifty. You will do 12, 13, 14%. You've got the HDFC twins, you've got the TCSs, you've got the software names, you've got the HDFC life insurance. So it's an autopilot mode. Those companies continue to do well. There's no problem there.
Okay, so Basant, what would you advise an investor then? I hear you loud and clear on valuations, on financials, but you started the interview by saying that if you're in the markets, you got to sort of stay vested and sort of see this play out. So what would your advice be to retail investors in terms of a strategy to adopt right now? Perhaps some of them have just entered, given the way markets were just seeing record after record. What do they do? Do they just stay and wait this out? Like, give us a sense of what you're anticipating, or what they should really, what kind of factors they should, think about when looking at their investment portfolio.
So the advice would be twofold. First is buy companies that have global triggers. Okay. So when I say global triggers, it could be you could buy an IT company, you could buy an global auto major, you could buy an auto supplier, for that matter, to anybody in Europe. They have got global triggers. Omicron will come, they will go. You get 3-4 more Greek and Delta names like that. That's not a problem at all. Secondly, you have to buy these companies. We've never done that. In our history, we've held companies that are very expensive, Page Industries or DMart for that matter. But right now, the time is there. Those companies used to deliver 30% earnings growth. So I wouldn't like to pay 70p for a company that's delivering 15% earnings growth, because when you get stuck in that, you get stuck for a long period of time. So I don't know how many of your viewers know Asian Paints, the most fascinated stock right now, did nothing for 7 years, 1992 to 1999. And I can give you a CAGR from 1982 to 2022 saying that the company delivered X percentage returns. But if you spend those 7 years with a stock which does nothing, only the guy who spent those 7 years knows how it is to be spending time with a stock that does nothing. So you have to buy very cheap right now, maybe a dividend support, maybe companies that are trading at bankruptcy valuations, you will get them, and you are getting them. So I wouldn't like to take names on that, because in the metal companies, companies, for example, there are companies, the kind of debt that they have repaid since last year is the net addition to the market cap since March 2020. So if a company has repaid, say, 70 rupees debt since March 2020 and its price has gone up since then by only 70, it means that there is no valuation increase. The company is still available at the same enterprise value. So these kind of companies, it's very hard to go wrong in them. If you go wrong, you'll just go wrong in the sense that they won't do anything for 2, 3, 4 months. They pay you strong dividends, very solid companies. So these are companies that you would like to back, rather than going and buying the fancy names and the ones that are hitting the streets right now.
What about autos, Basant? That's a segment which has disappointed largely. I mean, even in the midst of a fairly strong up move, autos did not create too much wealth over the last 15 months or so, maybe for good reasons, except Tata Motors, which has been a big turnaround play. How would you look at that entire clutch, including the name that I mentioned? So
Tata Motors, we own it. Again, it's not a recommendation. So Tata Motors is again a global company. So you figure out what's happening in China, whether people are buying JLR, Jaguar Land Rovers, or they're not buying them. So that's the function. Maruti is behind the curve. They haven't yet upgraded to the EV cycle. The Bajaj Autos of the name, of course, Bajaj was never a very aggressive company in that sense. They are happy with what they are doing. Again, there is a disruption happening. Ola is coming out with electric motorbikes there. So in the listed space, except for Tata Motors, because they were so enterprising and they went ahead with the EV thing, I don't think the other companies have shown that zeal. So that is why nothing is happening there. And again, Auto then is an India-centric story. India-centric stories are not doing well in this kind of a bull run.
We spoke about banks earlier, Basant, but one financial stock which has done quite well compared to banks is Bajaj Finance. I mean, it's that size too. and it ran up to 8,000. It's only in the last few weeks that we've seen some moderation in the valuation of that name. How would you approach that one relative to the other banks that we spoke about?
No, we had Bajaj, and it's a phenomenal company. It's the Indian version of buy now, pay later. In US, you've got a company called Square. In Australia, there's a company called Afterpay. So Square merged with Afterpay. If somebody wants to understand Bajaj, you should go and see what Square and Afterpay are doing. And with the kind of data Bajaj has, I think if they just got delisted and came out with an IPO, the market cap would go up by 50%. So that's the trick they have. I think Bajaj. See, when you're working with a 20, 30, 40,000 crore ticket size loans, you don't have to depend on the economy so much because you're penetrating newer geographies, you're penetrating newer classes of people. But if you're trying to work with a 10,000 crore rupee project financing, then you have to depend on GDP growth. You have to depend on whether the new expansion, the capex is coming across or not. So Bajaj is in the 20, 30, 40,000 ticket size, there it doesn't matter. Economy or no economy, they continue to do well.
Okay, so that's on Bajaj. You know, talking about the global front, Basant, because I'm still kind of, putting the pieces together from all that you've said. We're watching, of course, the Omicron scenario right now. We've also had the Fed kind of insinuate there may be as many as 3 hikes next year, which could be read in either way. But that's supposed to hit the pause button on the kind of moves we've been seeing on markets. So as Udayan was just asking you, are we really heading into a slowdown phase now? Because the other point of view is that this is just, a deep correction in a larger bull run, and it's nothing to worry about. In the past, we've seen these knocks and we've bounced back by the end of the week. So how is this different?
So the good part of Omicron is it's going to force the Fed to sit back and rethink and revisit. They cannot do 3 rate hikes with lockdowns all over. So I read that CNN has asked its people to work from home yesterday or day before. So you can't have this kind of a scenario and the Fed going across again and tapering across things. So, but the bigger problem, the bigger challenge for Fed to raise rates and for the ECB and for the Bank of England to raise rates is China cutting rates. So if China is cutting rates, Chinese yuan gets weaker. US wouldn't like to get into the same scenario that it was 3 years back when it took on China with the tariff deals and those kind of scenarios. So I think 3 rate hikes is good. They've spoken about it, whether it comes across or not. But on the other hand, the markets have run a lot. They need to pause. They need to think, they need to revisit, maybe take 2-3 steps back. We don't know. But I'm not outrightly bearish, but the DNA of a bull is a little bit behind me right now.
So, last question, Basant. I mean, this is a random guess question because none of us can predict it accurately, but we've corrected from say 18,500 to 16,500 on the Nifty. If you were to guess, how much more on the downside would you give it before you think fundamentals kick in and maybe longer term investors start to see value once again?
Nifty is easy. I don't think we're going to go below 16,000. I don't think we're going to go below that because the texture and the composition of the Nifty will hold the Nifty there. But whether we are really going to make a dash again, that's the difficult part. I think we'll oscillate somewhere here.
Fair enough. Great talking to you today, Basant. Thank you very much. Good to hear your thoughts as always. Thank you for joining in today.
If you like the video, do like, comment, share and subscribe.